Okay, so today we'll talk a little bit about landlords. There's been a lot of press recently about interest rate rises. A lot of people are panicking as their mortgage rates are coming off their deal with their existing buy-to-let providers. Getting a buy-to-let mortgage is a little bit more difficult than it was, mainly because the ICR, which is the stress rate which sits in the background, is a little higher. So we're finding it more difficult to move mortgages from one provider to another. But I thought I'd take this opportunity to talk to you about the fact that existing providers do have to offer you alternative deals once you come to the end of it. Now, brokers can help you with this as well. They will also search the market to see if you can get a mortgage and change it to an alternative provider. But it is always worth checking with your provider what offers they can offer you for the next 2, 3, 5 years. Even if you are looking in the longer term, go for a 2-year fixed rate or 2-year deal. And if the economy does settle, then you could look to potentially move lender. Something else that has changed since before COVID is that existing providers do want to retain their customer base. So historically, people have always thought that once you've come to the end of your deal, you will automatically be offered a far higher interest rate than a new customer. That has changed in the last 3 years, with providers really looking to retain their customer base. So you might actually find that the existing provider can give you a better deal than to move elsewhere, and it's far quicker and easier for you to do so, and mortgage brokers can help you with that. Something else that's of interest, and certainly in the press, is about sustainable lending and EPCs and reducing our carbon footprint. So lenders are really into the sustainable lending currently, and as a landlord, again, it's something that you need to consider. Your EPC expectations for current guidelines for 2028 is to be reduced down to a C. Now, people with large portfolios are thinking that's going to cost a lot of money to correct or to improve all of the properties. Something to bear in mind is if you do have properties that are unencumbered, so that means no mortgage on them, you can raise money against one of those properties to correct all of your other properties so that you're fit and ready for when the regulation does change. Even if it doesn't change in 2028, it will certainly change in the future because sustainable lending is the way forward. If you do improve your EPC rating, whether it be on your buy-to-let properties or on your residential properties that you live in, both of which, if you reduce the EPC to A or B, certainly, you will get a reduced interest rate and you will get benefits when you move the mortgage from lender to lender. So it's really about sustainable lending and responsible lending. As a general rule, residential rates are looking to come down. You are looking at sort of between low 4s up to mid 4s interest rate wise for 75% loan to value. If we're going up to the 90% loan to values, we're still low 5s, late 4s. So it is becoming far more affordable. With regard to buy-to-let rates, they are coming down a little bit, but not as much as the residential rates. Lenders are going into a price war, so you are seeing short, sharp drops in rates. So you will see a lender come into the market for 2 weeks, 1 week, 2 weeks with a particularly headline rate. Once their service levels are full, they will then take that rate back off again, but another lender will pick up the mantle at that point. It is always worth looking, especially if you're on a residential mortgage, to look to move lender. Rates are coming down, and just don't be worried. Don't worry about what the press is saying with relation to interest rates. I have a lot of my clients that are coming to me terrified that they're not going to be able to afford the mortgage that they've got on their house. Speak to your broker before you start panicking and listening to the general press.